Hi, everyone. Welcome to Live with Main Street. This is our first session of the year. I'm here with Jim, Cynthia, and myself. Hello. Our topic for today is 2019, what you can do to get this year kicked off right. So everyone's excited about their New Year's resolutions. Therefore, we've had 3 different questions come in for today's session, which is perfect for the 3 of us to cover. So we'll have Jim kick us off. Jim, the first question that we received via email, what are 5 things that I can do in the start of 2019 to make this my best year yet?
Great question, Liz. And thank you for introducing me. And I want to make sure people know your name is Liz. And here are the 5 things that really will kickstart a great 2019. Item number 1, increase your retirement contributions. Not everybody does the maximum, and the maximum this year, changed. It's $19,000 if you're under 50, and it's $25,000 if you're 50 and above. So try maybe a 1% increase or maybe a $50 increase per paycheck. Remember, when you do pre-tax contributions, your paycheck only goes down about 75% of the dollar amount that you're putting away because you're avoiding paying taxes and other payroll items. So that's really good. Number 2, don't forget about those catch-up contributions because that is $6,000 that you can put away pre-tax if you're age 50 and above. So that's number 2. Number 3 is see if your plan offers a Roth 401k or a Roth 403b, because putting in after-tax money means that you'll never pay taxes on it again. And so that's a wonderful thing to have. And although when you separate out the Roth 401k contributions into a Roth IRA later on, you won't have paid taxes on the gain either. So that's really a neat thing to do. The third thing is, that's the third thing. The fourth thing is, you might have a plan that has after-tax contributions and you can put more money in. The limit this year, depending upon how old you are, could be as much as $62,000 total. That is really a lot of money. Now that's different from the Roth 401k contributions. The after-tax money is accounted for separately, and you do pay taxes on the gain when you roll out those after-tax contributions into a Roth IRA. The growth stays in your normal 401k and it gets taxed when you're forced to take distributions, or if you take distributions, please, after 59 and a half, so you don't pay a penalty. Number 5, and the final one, is to people that might have a debt that they can't pay off in at least 3 years. And sadly, a number of our clients are in that situation, and other people we talk to that don't even become clients have a lot of debt. And so how can you pay it down quicker if you can't get a raise at work or change jobs? And that is the sort of the phrase of the year, side hustle. So look at the side hustles. If you need a list, we have extensive lists. There's articles out there that we can send you. And the most famous one, of course, Lyft or Uber. And I don't know how I got on the list, but almost once a day I get a please come drive for Uber or Lyft. I don't need a side hustle at this point, but if I had a lot of debt, that's one of the things that I would think about. Also, I have a client who's teaching English language on the computer to students in other parts of the world. So think about the side hustle to retire that debt as soon as possible. Quit paying other people's so you can have money to pay yourself. There you go, Liz.
Thanks, Jim. That's really fantastic feedback. I love your idea of the side hustle too, knowing that the best debt payoff plans happen within a time frame that can still have the client excited, right? It's really hard to look at someone and say, based on what you're doing, if you keep everything the same, you'll be out of debt in 6 years. You know, it's hard to keep momentum. So a side hustle is a wonderful way to speed up that timeline and to keep that intensity and that momentum going. Okay, Cynthia, question number 2. So we had one of our clients email in as well, and what they asked is, can you tell me about the major changes to the tax code from 2017 to 2018 as I prepare to file this year? What are the most important things that our clients need to know, Cynthia?
Okay, there's certainly a lot of changes that have gone on. I want to talk about a handful of them that just relates to individuals, not specifically businesses, just individuals. The first one that you might see is that the individual tax rates have changed. So there's still 7, but each bracket is actually lower than it was before. So the effective tax rate will go down. So for most taxpayers, you should see a decrease in your taxes. So that's a good thing. Secondly, the standard deductions have increased. They've actually doubled. So even though most people don't itemize, you'd probably be better off with these higher standard deductions anyway. So that is a big change from before. Regarding the personal and dependent exemptions, that's actually been suspended. And by suspended, I mean that a lot of these changes in the Tax and Jobs Act expire on December 31st, 2025. So when I say suspended, it just means that it is non-existent until 2025. So personal and dependent exemptions have been suspended. For itemized deductions, there's a lot of other things that have also been suspended. For example, the itemized deductions subject to the 2% floor, including the unreimbursed employee expenses, tax preparation expenses, or the investment fees. So what you pay your money manager to manage your accounts, that's also been suspended and not an itemized deduction that you can use. Some of you may use the medical and dental expenses. That's when you have a deduction for expenses that exceed a percentage of your AGI, your adjusted gross income. For 2017, it was 7.5. For 2018, it's 7.5. And then going forward, it's actually 10% of your AGI. So it's over that threshold of your AGI. So that winds up being a little bit, it's the same for this year, but worse for the following year. There's the SALT deduction that everyone has been talking about. That's the state and local taxes, and that's the real estate taxes as well, your property taxes as well. It's limited to $10,000 in total, and that tends to be worse for taxpayers in a high tax state. So places like California in particular, where there's higher taxes, you will wind up paying more in taxes if your SALT deduction is if your amount of state and local taxes is above that $10,000 amount. And you may have heard some rumblings when this first came out that the IRS is going to that some of the states are going to try to circumvent this cap. And pretty much the IRS is blocking that. So there is no hope of actually giving a donation to the state in order to get a tax credit to offset this unfavorable SALT deduction. That's just what it is. Next, regarding mortgage interest. The mortgage interest itself has stayed intact. Particularly regarding HELOCs, or for those of our clients that have HELOCs, you can still deduct the interest. However, now there's some limitations. First off, The limitation is reduced to $750,000. That's for a married filing jointly person, whereas last year, 2017 that is, the acquisition indebtedness was up to 1 million. So before, you were able to deduct interest paid on up to 1 million of acquisition indebtedness, as well as an additional $100,000 for any other kind of equity indebtedness, like HELOC. Now it's just 750, and that's only if you have taken out that equity line of credit on the house that you are using it for. So you can't take it out of your primary residence and put it toward your secondary residence. It has to be on the actual house that you're using it for. Additionally, some changes from before. There were moving expenses that have been either reimbursed or you are allowed to have deduction. Currently, that's also suspended unless you are a member of the armed forces. So something to keep in mind. Additionally, there is the child tax credit, and that is a good thing because the credit itself, which was $1,000, has now been doubled to $2,000. And the AGI phase-outs have been expanded as well, so more people will be able to use that. So that's definitely a good thing as well. Something that's new is there's something called a family credit, and that was not in existence beforehand. It's $500 credit for any non-child dependent. So thinking of your children that are over 17, that is a dependent, any elderly people or people that are disabled that you are, that is a dependent of you're one of your dependents, then you have a $500 credit for doing that, which is also a good thing because that's new. Additionally, one of the changes that they've made for this year is regarding the kiddie tax. Now, the kiddie tax was for a child's unearned income, so that's something through investments. They get charged or taxed at the parents' rate. Now, the unearned income is charged at the trust and estate rate. So the first $2,550 is not taxed. Above that, it's taxed at compressed rates, and it hits the 37% rate really pretty quickly. So it hits the 37% rate at $12,501. So very quickly you'll hit the 37% rate. Now, is that good or bad? That actually depends on what your parents' tax rate was. Sometimes it could be good, sometimes it could be bad. That's an issue, or that's an instance where it just kind of depends on what the parents' rate was. Next is Roth recharacterizations. Now, before you were able to recharacterize a Roth, so you'd be able to unwind it in previous years, and now you're not able to do it. So that is something that used to be available and is not available anymore. Next, I want to mention the 529 plans. So 529 plans previously were just able to pay for higher education, so for college expenses. That's what people pretty much know them for. And now you're able to pay up to $10,000 per student, not per account, per student, for elementary or secondary education. So that's private or public or religious schools. And you'd be able to do that free from federal tax, which is a good thing. But remember that 529 plans are actually state-run, and some states have not adopted the federal tax rules. So you may have to actually pay state tax on earnings of any amount that you distribute if you do it for like K through 12. Additionally, California is one of those that has not adopted the federal tax rules as they've created now. California also adds another 2.5% state penalty on top of that. I'm not aware that other states have done that. I think it's just California. But before taking money out of your 529 plan to pay for K through 12, take a look at the state to see whether they've adopted that as well. And lastly, one of the biggest changes that you may have seen is that the the exemption for estate and gift taxes has increased. It's essentially doubled before. So now for a single taxpayer, it's 11.2. For married filing jointly, it's over $22 million. So there'll be fewer and fewer people that actually have to pay estate taxes. And that's what I got.
Thank you, Cynthia. That was so helpful, and I know our clients will really benefit from that recap. Okay, guys, I'm going to finish us off here. Conveniently, I made mine the shortest and the easiest to answer because, well, I'm moderating today. So, no, all jokes aside, so the final question that we got, is it too late to make contributions to my retirement account? So I thought the easiest way for me to answer this would be to break it down based on the type of account that you have. So the most common one we hear about that many of our clients have and many of our family members have is a 401k or a 403b. Unfortunately, I don't kind of have any magic formula there. You had until December 31st of the current tax year of 2018 to make your contributions. So you are out of luck if you have one of those accounts. Next, we have our more traditional IRA or a Roth IRA. As most of us know, you have until the date that your tax return is due, which is for 2019 here. I keep wanting to say 2018. For 2019, it is a Monday, April 15th. So just know that even if you file an extension, you cannot add contributions past that date, past April 15th for your traditional IRA or your Roth IRA. Okay, the third type of account I want to cover is the solo 401k. So these are for our people that are self-employed. And I have some good news here. You can make your employer contributions up until your business tax return date. So that's either going to be March 15th or April 15th, depending on what type of organization you filed as. And this does include extensions, which are typically taken about 6 months out past that. And the same sort of thing follows for the SEP IRA. The employer contributions can happen up until the business tax return date plus extensions. And the SEP IRA, a lot of our clients use that either if they're self-employed or if they run a small business. And then the last one that I could think of to provide to you guys today is our simple IRA. The same follows for that. The employer contributions can be made up until the business tax return day, including extensions. One small difference though that I wanted to note is if you are the only person in your firm, right? So if you don't have any employees and you are self-employed with a simple IRA, you can actually make your last contribution on January 30th. So you could squeak in one more contribution here in the new year. So thank you, everyone, for joining us today. I've hoped that you found this useful. I know Jim, Cynthia, and I always enjoy getting the chance to be in front of you, at least as far as the computer goes, and talk to you as you make your way through the start of this new year. So thank you, Jim. Thank you, Cynthia. Bye-bye.
Bye, everybody.
Bye.